this thing on? Hey, happy Mother's Day to everyone here. You either are a mother, in which case somebody said, hey, that's a real mother over there, or if you're not a mother, then you probably most likely had a mother. So for all of you, I would like to thank you in advance for appreciating everything that mothers do, and also not calling to our attention those are things that we don't do. But this is a time to appreciate your mother, preferably by giving her gifts. We suggest gifts that would have a pretty solid value and could be easily returned without a receipt. Those are my favorite gifts. What I don't like is a regift that I can tell is a regift, like when it's got perfume on it already, or tag has been taken off. Please leave the tags on anything that you provide to us. It's a good idea to pay for my estate plan. These estate plans are very, very expensive for no good reason. In fact, they're put together by puppets. But I do need a good estate plan, so it would be nice for my children to pay for it. In addition, I heard that they will be installing a puppet government in Ukraine. So I would like to have a ticket to Ukraine so that I can go there to see if I could somehow fit into that puppet government. Thank you very much. And unfortunately, the presentation will begin momentarily. Please don't forget to call your mother, but she really doesn't want to talk to you, so keep the conversation short. Thank you again, and have a fantastic day. It's surely going to get better after this presentation. All right. Happy almost Mother's Day, and thank you for joining us for this presentation of Part 2, Estate Planning for the Wealthy, What You Need to Know. Part 1 was a couple of weeks ago, and you can see the replay on YouTube if you care to. It is 11 a.m. Eastern Standard Time here in Florida, and in fact, all the way up the East Coast. It's 11 a.m. Eastern Standard Time today, and at noon, which is 9 a.m. Vancouver time, for those of you who are in Vancouver and know Don Gaylord Bryan, we are going to have not only a ventriloquist, but also the talking puppets. He's got 3 of them, and it will be a very, very enjoyable conversation. In addition, at 1 o'clock, Professor Jerry Hesch, who is one of the most well-respected estate tax and tax professors in the United States, and certainly, in my opinion, the most well-loved, will be here at 1 o'clock, and he's going to be doing a dress rehearsal for a presentation he's been working on passing on the closely held business to key employees, and he will use his master's degree in mathematics to show you what the best income tax and estate tax techniques are for passing on the business to your employees and not to Uncle Sam. By the way, Don's book, if you get bored during my presentation, you can buy Don's book on Amazon. I don't think it's on Kindle, but probably Amazon will deliver it before my presentation is over. And on the left-hand side, you see the puppet that he is working on for me. And it's going to look even better than that by the time he's finished, because he builds these puppets out of wood by hand. The other puppets help him, of course. This presentation does not qualify for continuing education credit, primarily because it is not good enough. So next Saturday, May 14th, Marcia's birthday, you'll be watching me talk about tools and strategies to avoid estate tax tragedies. So please join me. You'll be watching it, but I'm sorry it won't be live because I don't want to lose what's left of the time together with Marcia by forgetting her birthday. May 21st, creditor protection in estate planning, and May 28th, the mathematics of estate planning, which is based a lot upon Professor Hesch's materials. I'm very excited May 25th to be talking to Husang Cho, my friend, who is in Texas and California. He's boarded in Texas and California. We're going to be talking about estate planning for the Korean American family. And if you know of any estate planning professionals who have roots in another culture or another country, I would love to have them aboard. Marty Shinkman and I are providing these as part of a diversity program for the National Association of Estate Planning Councils, and we have some planned, but not enough. So please suggest somebody or come forward. Okay, skipping over a lot of the slides that I covered last week, where would I like to start? I had some questions from the prior presentation on the S corporation exercise that I went through. So I just want to go through it again. You have an S corporation here, and it receives $5 million a year of income. It's worth about 6 times earnings. Let's say it's worth $33 million. And it's expected to be worth $60 million in 10 years. And we believe that if we gift 30% non-voting member interest to a trust, that we can discount the value and consider that to be worth only $6 million, because 30% of 33 million is 10 million, and then take a discount for lack of marketability, lack of control. It's a $6 million transfer. We set up an irrevocable trust. We set it up in Nevada so that if things go badly, the client could actually be added back as a beneficiary of the trust. The client gives the Nevada Trust Company a $10,000 check to put in an account under the name of the trust, so there's a real live Nevada asset. The client really wants to control the rest of the assets, so a limited liability company is set up. It could be in Nevada, often it's in Wyoming for reasons I could explain, and it's owned by the Nevada trustee, and we make a seed capital gift from the client to that trust for $600,000, which is not coincidentally based upon 10% of the amount of the promissory note. That is what we call a seed capital gift. And now the client sells this 30% non-voting member interest for the $6 million note. And what have we done here? Well, we've complicated lives, we've caused legal fees, we've enabled an appraiser to make $10,000 telling us how much this 30% non-voting member interest is, but we have converted a $10 million asset into a $6 million note, and it is earning interest at approximately 2% a year. So we're getting back $120,000 a year. In the meantime, 30% of the K1 income from this S corporation is going to the Nevada Trust Company, which allows it to pass to the LLC so that the client or a loved one of the client is managing the LLC. It helps to give a business purpose for the client's children to manage the LLC. So 30% of 5 million, that's $1.5 million a year going into this LLC. And the client's only getting $120,000 a year. So the end result is after 10 years, the LLC has about 15 million. And that's based upon a $600,000 gift. Now it still owes 6 million on the promissory note. So it's ahead by $9 million. And I'm not even counting the growth on the investments there. So after 10 years, maybe this would be 20 million. So that would be a delta of $14 million. For those of you just joining us, I explained earlier that Delta is ready when you are, but Delta is also not only an airline, but it's a Greek math term, which means the difference between. That's the difference between. So Delta Dawn was the difference between a politician's career and the end of the politician's career. And that's where the word Delta came from. So anyway, after 10 years, the company sells for 60 million, and 30% of 60 million is 18 million that goes into the trust. So the trust has $33 million. Not a bad decade for this family. Now you ask, what happened to the income? Who paid the income tax on the income? And we have good news. The client paid the income tax on the income, which further reduced her estate. And then you ask, why do you need this purple irrevocable trust number 2? And by the way, that should say irrevocable trust, and Kelsey will remind me to fix that slide. So this irrevocable trust may control enough of the, oh, actually it's not. Let me go here. All right, well, I could have shown an irrevocable trust owning 0.1% of the voting member interest in the LLC, in the S corporation, and giving the trusteeship of that trust to an unrelated but responsible person, replaceable by the client, who has the sole right to determine if and when the company will ever liquidate or make a distribution, to avoid issues with our favorite code section 2036A2. So that is the S corporation exercise. The second page just simply shows the aftermath and how nice this is. But let's say that this is a bigger company. It makes $20 million a year. So it's worth $180 million if it's worth 6 times earnings. So 30% of $180 million is almost $60 million. So the concern here is that the undervaluation, if the IRS says you took too much of a discount, you owe a big gift tax if you sell this for a note. Well, we could use what's called a formula clause in our note. The IRS doesn't really like formula clauses, but they seem to be standing up. But instead of a installment sale for a promissory note to a trust, we can set up what's called a grantor retained annuity trust. So if we cause this to be a transfer to the grantor retained annuity trust, the grantor retained annuity trust agrees to pay $9 million a year for a period of years sufficient so that there is no gift considered to have been made. So 30% of $180 million is about 60 million. Take a 30% discount off of 60 million. So 70% of 60 is about what, 43 million. So how many years of 9 million a year would you need to wipe that out? About 4.5 years. So the GRAT agrees to pay $9 million a year to the client. The GRAT receives 30% of 30 million. It receives $9 million a year. It uses all that money to make the 4.5 payments. And then after that, everything in the GRAT passes completely estate tax free. Now, what happens if the IRS comes out and says, hey, wait a minute, you undervalued this. You said it was worth 40 million. We think it was worth 80 million. You owe us $40 million worth of gift taxes. 40 million times 40%, $16 million. Client's a little bit upset. Doesn't really want to pay gift tax of $16 million. So fortunately, the Internal Revenue Code at section 2702, and you can go read it in your spare time if you want, says that when you set up this type of a trust, you can provide that the payment is based upon a formula, an algebraic formula, which says I will make payments sufficient so that the grantor retained annuity trust has a 0 or very small value on day 1. And I estimate that this comes out to 9 million a year. But if it turns out that it's worth twice as much, then the payment will be 18 million a year. So the IRS auditor comes out, says, wait a minute, I disagree with your valuation. It wasn't worth 40, it was worth 60. Okay, instead of 9 million a year, it owes 13.5 million a year. We'll go ahead and make those bigger payments, but still the excess is out of the estate for estate tax purposes. So that is the GRAT. Now, when would you use a GRAT? You would typically use a GRAT when you're concerned that you may owe federal estate tax as the result of an installment sale. A GRAT is not necessarily as good as a dynasty trust or a spousal limited access trust. The reason for that is that a GRAT, whatever's left in that GRAT after the payment, can be held for the spouse, held for the family, but is not what we call generation skipping tax exempt, which means that on the death of your children, the GRAT assets will typically be subject to either generation skipping tax, which is a 40% tax, or estate tax at the child's level. And that's where we as tax lawyers talk about a trust that is GST exempt. So when you go to your lawyer and you have an irrevocable trust, you want to say, is my trust GST exempt? And the reason for that is if it's GST exempt, such as this trust here, which receives a seed capital gift and buys an ownership interest in the S Corp, this trust can be GST exempt, where not only will it benefit the spouse and the descendants and the descendants of the descendants and the descendants of the descendants, but it will never be subject to estate tax at any of their levels. And that's why we want to put as much into the installment sale on this side as we feel comfortable with, knowing the gift tax exposure, even though we use formula clauses to ameliorate it. And if anyone in the audience is named Amelia, I wasn't referring to you. I was referring to the concept of adjustment. That wasn't a very good joke, was it? So this is where the rubber will meet the road for grantor retained annuity trust planning. And I plan to do a little bit more on that before the end of this extremely long hour. Now, unless you are living in a cave, you know that interest rates are going up along with everything else. So the long-term applicable federal rate that we can use when we set a long-term note up is now over 2.25%. The April rate was 2.25%. Now for a sale, and in my opinion, giving money for a note is probably a sale, you could use the lowest of this month or the prior 2 months. So right now in May, you could use 2.14% if you do this installment sale. And you should have done this installment sale a long time ago. And particularly, if you had done it last September, you could have been at 1.73%. Well, it will not surprise me. The long-term rate is based upon 10-year T-bills, and I expect them to go up with everything else. So that would be a reason, if you have a long-term note with family members and it's higher than 2.25%, then you may want to go ahead and renegotiate that note to fair market value, and I can share articles with you on the pros and cons of doing this. Okay, I spoke about community property trust last week, so I don't have to, the last time, I don't have to do that this time. I want to mention more of charitable planning. I opened the program a couple of weeks ago by saying that my favorite, or one of my favorite tax professors, Carl Miller, University of Florida, 1984 or 1983, said, the estate tax is a voluntary tax. It is paid by taxpayers who don't plan ahead or who want to pay it. Now, in my opinion, the US government is the biggest charity in the world because of all the things it does for so many different people, but most of my clients do not want to give to the US government. And giving to the US government is not tax deductible. So more of my clients would like to use a charitable planning technique than no technique at all. And some of my clients are actually charitable. So the IRS posted to their website in March a new memo on the estate administrative note exception. And I think I have should have something here that explains the estate administrative note exception. I could have sworn I did. Well, we can pretend I did. Pretend I just showed you a slide on this and that it was a very good slide. Anyway, here's what I can do. I can say I have a $100 million business and I have a foundation that I would like my children to run when I die. So my trust says when I die, transfer my business to my private foundation. And there will be no estate tax as the result of the estate tax charitable deduction. But in my estate plan, I put in one innocuous paragraph which says that my children or a dynasty trust already established for my children will have the option of buying that company for a note. And if the company is worth $100 million, then the promissory note payable by the dynasty trust will be $100 million. And then under my estate plan, I can provide that the company or any note received for the company will go into the private foundation. So my children say, hooray, hooray. The first good news is Dad died. We got him out of the way. The second good news is no estate tax. The third good news is we bought the company in a GST exempt trust. It's creditor proof, it's divorce proof, it's GST proof, and that trust owes a $100 million note to the foundation, but it's only at interest at 2.25%. So we don't really owe 100 million. In fact, we hired a valuation firm who told us that that note is only worth $55 million because it's a 30-year or a 25-year 2.25% note with no prepayment option. So we'll just go ahead and approach our private foundation and say, hey, how about if we cash you out for 55 million? So then we'll keep the delta, which was ready when you are, of 45 million, which is better than paying $40 million in estate tax. Because instead of paying $40 million of estate tax when Dad dies, we'll just settle this note a few years after Dad's death into the private foundation. And then we'll be able to manage the private foundation and take salaries out of it and reasonable salaries only. So that feels better for the family. Well, can you give a note to your private foundation? The answer is yes, if you follow this estate administration exception. But can your private foundation cut a deal and give you a discount on the note? They cannot. So what you have to do then is convert the private foundation to a public charity by making it into a school, a clinic that qualifies as a hospital, a medical research organization, a church, synagogue, mosque, or whatever you may choose, or you start advertising a lot for donations and you get enough donations so it's considered to be a public charity because you get enough of your support from the general public. So that is the administrative note exception. I spent some time on it because it is very, very underused and very, very not so understood. So that talks about that. Now, I did speak 2 weeks ago about the installment sale to a dynasty trust and using a NIMCRUT, a net income makeup charitable remainder unit trust, to handle the sale of a company. And the way this works, just to cover it briefly, even if you're not planning to sell the company, here's what you can do. You set up the dynasty trust for your children, maybe your spouse. It could be a Slack dynasty trust. You sell stock in the company, which could be a C corporation, to the Dynasty Trust for a note. And then you place the stock of the company under a charitable remainder trust. The charitable remainder trust will not pay tax on the dividends it receives from the company. The family will not pay tax until the charitable remainder trust makes a payment to the family. The charitable remainder trust is set so that it pays up to 11% of its value every year for up to 20 years, but you can delay the payments. So the family could wait 13 or 14 years before they get their first huge payment and only pay the income tax at that time. During that period of time, the company stock may be sold and there is no tax on the sale until those monies are withdrawn. Now, planners out there, think about this. If you first put the company into the NIMCRUT, and the NIMCRUT is there a year or two, and then your clients sell the NIMCRUT interest to the Dynasty Trust for a note, how are you going to value that note? Let's say that the NIMCRUT assets are worth $3 million, but 10% is going to go to charity, and you don't even know if you're going to get a payment for the first 14 or 15 years. You could take a nice discount on the note. So that is another charitable planning technique, and the charity only gets an amount equal to 10% of the day one value of the NIMCRUT after 20 years, if the assumptions that you would normally make turn out to be true. So the other use of the charitable remainder unit trust is as the recipient of an IRA. So I die, $1 million IRA goes to my daughter. She has to pay that tax in 10 years. She doesn't want to pay that tax in 10 years. That's a lot of tax in 10 years. Let's say that she may retire in 12 years and she'll be in a lower bracket then. That's when she'd like to pay the tax. Okay, I make the IRA payable to the charitable remainder unit trust, which can pay her 10.87% a year for 20 years. That defers a lot of it. Or I could use a NIMCRUT where she could use the rules to not take anything out for the first 11 years and then take it out after she retires when she's in that lower bracket. And then at the end, something goes to a foundation that she can run to keep her busy in her retirement years. So those are two of the charitable techniques that I believe are really, really underused. The other underused technique is to simply have a private operating foundation which does something active for your community or for people or the environment somewhere, and go ahead, put 1% voting stock of a company into a special trust that's held for both charity and people, and your client, the donor, can be the trustee of that trust. 99% of the company goes to the private operating foundation, generates a tax deduction, and then the private operating foundation, if it's receiving C corporation dividends, those come income tax free. If it's receiving lease income from net leases, that comes in tax free. Dividends, interest, tax free. And then it just spends 4.25% of its net worth on expenses, even though it may have revenues that are more than 4.25%. So that's something that families like to do. We find sometimes that families plan to do this on death. Well, why not do it while you're alive and get the tax deduction? The other mechanism, the charitable lead annuity trust, your clients are not going to be interested in this unless you can explain it. But the numbers are very persuasive. You put your entity under the charitable lead annuity trust. In this example, it pays $100,000 a year to charity for 10 years. And what's left after the 10th year can all go to trust for the children. It's a zeroed out CLAT, so there's no gift tax for putting the assets in. So you put $1.2 million of assets into an LLC, give the 99% non-voting member interest to the CLAT, and assume a 7% growth rate in the assets, $100,000 a year to the charities. You get a income tax deduction the year you set this up for $1 million, basically, or just under $1 million. And the children end up with $848,000 gift tax free. So that's why CLATs are so impressive. Look at this CLAT number here. Put your $10 million into a CLAT. You assume a 33% discount, 6% growth rate, a 20-year CLAT based upon present values and assumptions. The children at the end of the day get 73% of the value. The charity gets 27% of the value. On the other hand, if you leave it to Uncle Sam, if you leave it directly to the children, Uncle Sam gets 40% and the children get 60%. So the CLAT, a testamentary CLAT, is a very good thing to have. People are asking me, so that's enough for charity. I know so many of you are saying enough of charity already. Oh, by the way, Rob liked the Ukraine joke. Thank you very much. I appreciate it. And Tom is on the second round of Coke and popcorn, probably caffeinated Coke. If it's decaf, switch to caffeinated pretty quickly here. Okay, I don't think that Governor DeSantis has signed this bill. I know he will not be signing it at Walt Disney World. But if this bill passes, then Florida will have a $1,000 year perpetuity level. So I could, right now, if I sign a trust today, it can only go 360 years. That's not long enough. Alaska has 1,000 years. Delaware has really infinite, except for real estate. Florida wants to be among the best. So we'll go to 1,000 years when Governor DeSantis signs this bill. In addition, right now, my spousal limited access trust, if I form it in Florida, it cannot be for me. It can be for Marcia and our descendants, but not for me. Even if Marcia dies, it can't be for me. That's where you may want to have a floating spouse clause, where if Marcia passes away, my next spouse would be able to be a beneficiary. Don't mention this to Marcia, by the way. So, once Governor DeSantis signs this new bill, then a SLAT entered into can provide that this SLAT is for my spouse, but if my spouse predeceases me, it can be for my lifetime health education, maintenance, and support, and I will not be considered to have been a contributor to that trust for Florida law purposes, which means my creditors won't be able to reach into it. So if he signs this bill, people who have spouses with short life expectancies are going to want to be setting up Florida SLATs. But this bill will not permit a trust that I set up for my wife to be held for my benefit if I become destitute, which would likely occur if she were to divorce me. So that is why Nevada, Delaware, Alaska, South Dakota will still have the edge when you compare whether to do a SLAT here or to do a SLAT there. This reminds me of an important story. It's a sexist story, but I think I can still tell it. A man and his wife are playing golf, and she has a rare and terrible disease that enables her to play golf, but a very short life expectancy. In fact, as a client said to me yesterday, he said, and he's a doctor, he said, she's a week from hospice and 3 weeks from a garage sale. So this wife had a short life expectancy. And she said to her husband, there's just something I have to ask you. I love playing golf with you. It's been so important to our relationship. what are you going to do with the golf clubs after I die? And he said, well, I love you and I love the golf clubs and I love playing golf with you. And after you die, I know you want me to be happy, and I'm going to find a very, very nice next wife, and I'm going to give this next wife your golf clubs. And she said, well, you can't just do that because I'm a lefty. And the husband says, that's all right. So is she. So sorry, I kind of goofed that joke up a little bit, and all the sexism. Sorry about all that. Okay, let's end the world of slats here. And we have lots of slat stuff on the website, on the YouTube channel. If you go to YouTube chat slat, but you have a lot of literature here. And I always show the installment sale, so I'll skip the installment sale today, and everybody can say, oh my gosh, am I glad that he is skipping the installment sale. Well, when you do an installment sale, so I put $10 million worth of assets in an LLC, and I sell the 99% membership interest in that LLC to a dynasty trust for $7 million note. Now the delta is ready when you are of $3 million may be considered by the IRS to be a gift. And by the way, I've made a $700,000 gift to the Dynasty Trust as a seed capital gift. So what do I disclose on my gift tax return? I definitely have to disclose the seed capital gift if it exceeds the $16,000 annual exclusion. The funding of the family LLC with $10 million of assets does not need to be reported because that's not a gift, because I put $10 million in and I got $10 million worth of assets. And by the way, the case law is very generous. If my daughter and I set up an LLC, she's 1% voting, I'm 99% non-voting. I put $990,000 in, she puts 10% in. That is not a gift under the gift tax law if you make pro rata contributions, even though you don't own the voting share. That's pretty interesting, isn't it? Well, it's interesting for nerds like me. Let's go to the next number 3, though. I'm selling, not gifting, but I'm selling this 99% non-voting member interest into the trust. Do I need to report that on a gift tax return? And the answer is the best practices will be to get a full appraisal of that LLC and its discount, which will typically cost $4,000 to $6,000 if it owns marketable securities and bonds and stocks, and $12,000 to $14,000 if it owns a business. Get a full-blown appraisal and disclose it on the gift tax return. And the good news is that if you do that, the IRS only has 3 years to challenge it. If they don't challenge it within the 3 years, you're home free. That would be the reason to report it. Reason not to report it, number 1, you may not need as extensive of a valuation report. You need something more than a napkin, because napkins, you can't fax a napkin. You would at least use an 8.5 by 11 piece of paper, but you would want to get sort of at least an opinion from a reputable CPA or a business broker, and then not file a gift tax return, or get your full-blown appraisal and not file the gift tax return. What's the advantage of that? Lower risk of audit. Now, we don't know how many gift tax auditors there will be in 3 years. It doesn't sound or look like there will be that many. But still, it's a choice that you have to make. So then if you don't report it on the gift tax return, then in 20 or 30 years, when you die, do you think the IRS is going to go back that far? And the answer is maybe they will, maybe they won't. I don't think it's likely that they will. So a lot of you who have parents, like the lady who started the talk today, the intermission, the beginning of the talk, they just don't want to spend the money on all this. So my legal fees might be $10,000 or $15,000. Then the appraisal's another $15,000. Forget it. Well, what if my legal fees are $15,000 and an informal appraisal is $4,500, and you don't have to pay the extra money to disclose all this on the gift tax return? You just have a simple gift tax return with a seed capital gift. They say fine, or let my kids pay for the difference. And so it is better to have loved and lost as opposed to never having loved, allegedly. But it is also better to have gifted and not, to have done an installment sale and not to have reported it on a gift tax return than to not have ever done an installment sale before. It's not what you can do for your dynasty trust. Ask what your dynasty trust can do for you. If you're the grantor, it can't do anything for you unless it's in Nevada and the trust protectors add you back. Sorry to get whimsical and philosophical there. Okay, a lot of our clients have, and by the way, thank you all for staying on the talk. We're slowly growing the population of this talk. And those of you who have fallen asleep and not able to leave, we appreciate that also. It helps with the count. And hello, Sally. I'm working on your chart that I promised you Monday. It's almost ready, and I'm looking forward to sharing it with you. All right, you have a large note in place. You sold $30 million worth of assets for a $30 million note. Let me mention that at a recent tax conference, Jonathan Porter, who is the most well-known estate tax litigator, has reported that the IRS is saying that a promissory note issued at face value at the applicable federal rate is a gift if it's a long-term note. So in other words, I put $30 million into an LLC, I take the 99% non-voting member interest and I sell it for a $23 million note. Delta is ready when you are. Between 23 million, which is the value of what I gave, and the fair market value of that note. It's what would you pay me for a $23 million note that you know you're going to get paid, but you're only going to get 2.25% interest for 25 years, and then it's going to balloon. So that's only worth, say, 18 million. So the IRS is saying in a tax court case, there's a $5 million gift. Well, if you read Internal Revenue Code section 7872 and the committee reports that came out in 1984, my first year of practicing law, when I read section 7872 and wrote my first article about it, makes it fairly clear that Congress did not intend for there to be a gift at that time. And the Frazee case, which is impressive because Frazee had two Z's and two E's in their name, F-R-A-Z-Z-E-E, said that as well. So we don't think the IRS has a good position there. But I think I said this a couple of weeks ago, go ahead and put a new adjustment clause in your agreements to say, and if the note is determined not to have a fair market value equal to its face amount by a court of competent jurisdiction in the gift tax arena, then go get a Coke and a popcorn, come back to the arena and adjust the note to the face amount equal to the sale amount. If you want to do that, it's going to be called a hybrid king clause, having nothing to do with the King of England, having to do with the 1976 court case of King, where King sold something for a note and basically said, if it's really worth more than I say it's worth, then go ahead and increase the face amount of the note. So the court ruled that there was no gift tax owed. It was appealed and the appellate court agreed. All right, so let's say that you're standing there today and you have a $30 million note owed to you from an installment sale that you did 3 or 4 years ago. So what are you going to do with this note? And there's a lot of alternatives, and we wrote an article called The Biden Third Step. And I think we need to take it out and make some red line changes now that we have this anti-frazee position that the IRS is taking. And now that we have the new clawback proposed regulations that just came out. But one thing you may want to consider doing with that note is going ahead and getting paid. You know, the Dynasty Trust owes you $20 million. The valuation firm says the note is only worth $16 million. Well, maybe the Dynasty Trust should write you a check for $16 million or give you $16 million worth of bonds or other assets, and then just put that, do an agreement that you're accepting that based upon what you think the fair market value of the note is, and then decide if you want to disclose that on a gift tax return or not. Just get the note out of the way. Or do you put the note into a GRAT, and the GRAT pays you back 4 annual payments, just over 4 million. I mean, just over 4 million a year each. You think the note's worth 16 million? The GRAT gives you 4 million a year for 4 years. It's a very small gift. And if it turns out the note was really worth 20 million, then the GRAT owes you another 4 million over a period of time. And then you don't have a gift tax challenge. You just have more assets in your estate. So what to do with the note becomes more and more interesting. But one thing I suggest is that you look at your creditor protection planning, because, you know, we were all in a hurry. John and Maud, they both sold, they put all the assets that we wanted to freeze into LLCs. And then we froze all those LLCs with non-voting member interests, sold them to these trusts in exchange for notes. Now, John's got a note, but John also drives in Florida in the rain at night, which is why he is so popular at the ACLF where he lives. Well, let's not leave that note in harm's way. We could put it in tenancy by the entireties if you live in Florida, or we could put it into an LLC. The LLC could be owned 99% by John and 1% by Maud. So then if John gets worse and worse memory, he can't go do something dumb with the note. Maud controls the LLC. Then under Florida law, if somebody gets a judgment against John, they can't attach the note. Well, now John dies. What's the LLC 99% interest worth in a 20 million note? Well, you got the 20 million note, which is worth 16 million minus, let's say, a 1/3 discount. So that's an 11 million. Does that get John below the exemption amount? Maybe it does, maybe it doesn't. But go ahead and think about what to do with these notes. And I'll be glad to send you the Biden Third Step article if you like. And here's a chart that I made based on an article by Jerry Hesh. As some of you know, I love to do charts. So you can see that these are real live cases that allowed real live large discounts for notes. Now, the self-canceling installment note and the private annuity are very, very important to understand and to use. And every 2 or 3 years, we see a family with tens of millions of dollars, if not much more, of wealth completely avoid estate tax by making lemons out of lemonade. The client calls and says, I've got, bad news, 3 to 4 year life expectancy. And the planner can say, that's great news. You just saved millions and millions of dollars of estate tax. Because you can do what Mrs. Kite did in the tax court case of Commissioner v. Kite, K-I-T-E. There's a YouTube video on it. If you search Annuity Kite, Gassman, it'll come up and it explains how Mrs. Kite was not in good health, but under the Treasury regulations, you only need better than a 50% chance of not dying from an identifiable disease. So you might have 4 diseases, and the doctor may say, because you have all 4 of these diseases, your life expectancy is 5 months. But each of these diseases looked at separately would not be expected to take you down for 8 months. And therefore, you have better than a 50% chance of not dying from any single disease within the next 6 months. So you could sell all your assets to your children in exchange for the obligation of your children to pay you over time based upon IRS tables and what we call the 75/20 rate, as if you were in normal health. Now, the software that we use, which mostly is Tiger Tables or Number Cruncher for most of us, says if I give $1 million and I'm age 73, here's how much I have to get back every year. But Mrs. Kite's advisors knew that they didn't have to use that software. They could hire Jerry Hesh, and he always does this by hand, and he could show you how Mrs. Kite in her early 70s didn't have to get this first payment for 9 years. And it was going to be a big payment, but she died before the 9th year. So her family was very sad that she went, but very glad that they paid 0 estate tax. A just reward for the widow of the man who invented the defibrillator. So be on the lookout. Now, can you convert a note to a self-canceling note instead of doing a private annuity? And there's reasons why. It's risky to do a private annuity from a dynasty trust unless the dynasty trust has a very large value. If you're in your early 70s, that dynasty trust needs to be worth about equal to what the assets put in for the annuity are, because of something called the probability of exhaustion test. Now, the probability that you're already exhausted now is low, but wait till after Jerry's done at 2 o'clock. That's why we're going to give you the 1 hour break, the entertainment by Don Noseworthy, in just 9 short minutes. So you can go to Tiger Tables or go to Number Cruncher and decide if you want to make your promissory note self-canceling. You have to pay a higher interest rate, and they only bring you to a life expectancy balloon, but you could manually calculate a longer balloon if you want the interest rate to be even higher. So I want to make sure I cover GRATs a little bit more here, and then I may have time for qualified personal residence trusts in the next 8 minutes. Okay, a GRAT. You are the grantor, your spouse is the beneficiary and trustee. You put in $4 million of anything. The GRAT agrees to pay you $1,976,000 the first year anniversary date. And actually, you can receive it 180 days late, like the US mail. And then the second anniversary date, $2,372,000 worth of something. So you put in $4 million worth of Apple stock, and after 2 years, the Apple stock has doubled, and there's going to be a lot in this GRAT. There's going to be a lot of value in this GRAT. It can benefit your spouse without ever being subject to estate tax in her estate or his estate, and then pass for your lovely children. And that's the GRAT. And the beauty of it is, if you undervalue the asset, the payments go up proportionally. You don't owe gift tax. So a couple of weeks ago, I think I showed this schedule where this company gets $3 million a year in income. So 10% of the company gets $300,000 a year in income. Multiply that by 5, it's worth about $1.5 million before discounts, $1 million after discounts. So, or maybe $1.2 million after discounts. So he puts it in the GRAT, and he's going to get $119,000 a year back from the GRAT for 10 years, and then after that, it's all for spouse and children. So what do you do here? You get 300,000 a year in the GRAT. The GRAT pays 119. It's left with 180,000. At the end of the 10 years, assuming a 7.5% rate of return, the GRAT has 2,500,000 and there's no gift. I like that. Plus it owns 10% of the company, which may still only be worth $1,500,000. That's a $4 million delta, is ready when you are, that you have here without paying any gift tax at all. But the GRAT needs cash flow. So what do you do to get the GRAT cash flow? Let's say that your only asset is a FLP interest, 41% that you own. And you want to put that in a GRAT, but the FLP doesn't pay dividends. And it seems, like it wouldn't make a lot of great sense just to get back limited partnership interests. So here's what you do. And this is based in large part upon outlines provided by Stacy Eastland, including pulling the rabbit out of the GRAT hat. You set up an LLC, and the LLC, you own 100% of it, and it owes you a $10 million promissory note. And the LLC receives 41% of the limited partnership, and the LLC receives cash and marketable securities. Now, these are similar to marketable securities, but they're from Greece. So they're marketable securities worth $4 million. So what is the LLC worth? I think the LLC is worth $6 million. The IRS thinks the LLC may be worth significantly more. Because the LLC owes me $10 million, by the way, I think if somebody came on just now, we need to mute you. It's either Professor Hesh or Noseworthy. Okay, that's good. So now what do? We, of course, form a GRAT. And we transfer the 99% non-voting member interest in the LLC to the GRAT. We're still owed a $10 million note. So the GRAT, if we use the $6 million value, only owes $1.6 million a year for 4 years. So now we've been able to take that discount on the FLP. We are bulletproof from a gift tax standpoint, as long as we have used reasonable appraisals commensurate with what other people are doing in this industry, nothing overly aggressive that would cause the IRS to try to say that the GRAT is not really a GRAT. And we are going to use the cash and marketable securities and some of the distributions from the FLP to make these payments. So now if the IRS says, hey, this FLP was worth $10 million more than you thought, well, we're sorry, we did our best. We understand that the GRAT owes more now, but there's no gift tax. That is a leveraged hybrid GRAT. And I have a chart here for the advisors. If you try to do this at home, then you could hurt yourself. But it does compare the skin to the private annuity to the GRAT. And I think I'll ask Jerry Hesh to come back here some Saturday, and we'll talk about this comparison. Finally, I promised that I would talk about qualified personal residence trusts, but I did not leave myself enough time. So I'll just get started on the Cupert discussion, and it'll be done in 2.5 minutes. Hey, Don. Bye, Don. Okay, so you put your assets in the qualified personal residence trust, and what you get in exchange is the right to use the asset, also known as your home or your vacation home, for a term of years that you choose. And because your children, who are the remainder interest beneficiaries of this Cupert, don't get to use the property for, say, 10 years, my gift of $1 million home to a Cupert that they can't have any benefit from for 10 years is maybe a $600,000 gift. I have to use the tables in Tiger Tables or Number Cruncher because it also is based upon my life expectancy and the term. And you know what? If I have a $2 million home and I only give half that home to the Cupert because Marcia owns the other half and she gives it to another Cupert, then I'm not even going to consider that $1 million in the first place. I'm going to consider it $850,000 and then take a 40% discount. So I've used very little of my exemption up. Now I get to use the house for free during the 10-year term. At the end of the 10-year term, I can continue to use the house, but I have to pay fair market value rent, which further reduces my estate for estate tax purposes, which is a good thing for me or for my children. Economically, not so good for me, but it helps me keep my estate under control. So I can set up a Cupert for Marcia and our descendants. Marcia can set up a Cupert for the descendants. My Cupert might be a 15-year Cupert because I'm 63. Marcia's Cupert might be a 20-year Cupert because she has a longer life expectancy. And so then in 10 years, I start paying rent, but she doesn't pay any rent. In 15 years, we're both paying rent, and all those assets are out of our estate for estate tax purposes. So we'll do a special talk on Cuperts in the not too distant future. And I did not answer any of your questions today. Let me just look. Frank liked the golf joke. Thank you very much. I don't feel so bad that I blew it. And then Stuart, in S-corp planning, if the grantor dies, does the trust have a Q-sub SBIT issues to deal with? Yes, but you can deal with the Q-sub SBIT issues, or the family can buy the stock back out of the dynasty trust for cash. Okay, Rob liked the Ukraine puppet joke, so I'm glad about that. And Sally, thank you for your patience. Okay, so